Okay, so I want to go over some option terminology. This will help you understand what I'm talking about in these lessons, and will also help you understand what others are talking about when you start trading. So, you might have heard me use the term strike price in one of the prior lessons. This is also known as the exercise price. So strike price, exercise price are the same thing. So the strike price or exercise price is the price at which an option buyer, so if you buy an option or a holder of an option, can purchase in the case of a call. Remember, with calls you have the right to purchase or buy, or sell in the case of a put option. Recall, with a put option you have the right to sell the underlying stock from the option seller. So the strike price is that price at which you can buy or sell, depending on the type of option you have, call or put, the underlying stock. So, expiration date. What is the expiration date? The expiration date is the last day that an options contract is valid and therefore can be exercised by the option buyer / option holder. Now recall that an option buyer has the right but not the obligation to buy the underlying stock. In this case, we're talking about a call option on or before the expiration date, right? And if it's a put option, they'd have the right to sell, but not the obligation, the underlying stock on or before the expiration date. So you want your price movement, whatever direction you're betting, to happen before the expiration date. So what is the option premium? Well, the option premium is the amount of money paid by an option buyer in exchange for the right to buy or sell, depending on if it's a call or put, the underlying stock from or to the option seller. Stated differently, the option premium is the amount of money received by an option seller in exchange for the obligation to buy or sell the underlying stock from or to the option buyer. So you see those two different statements there. One's from the perspective of the buyer, and one's from the perspective of the option seller. But they're basically saying the same thing. For stock options, the premium is quoted in dollar amounts per share. And most contracts, the vast majority, so I would just take this as pretty much gospel, represent the commitment of 100 shares. So in the last course, we talked about how you have to multiply the quoted price by 100 to understand how much you need to pay to buy that option contract. What do we mean by underlying stock? So when we talk about the underlying stock, we have to remember that an options contract is a derivative instrument. So it's a derivative financial instrument with a price that is based on a different asset. That's why it's called a derivative. Its value is derived on the value of an underlying asset. A stock or equity option is a derivative. Its price is based on the price of the stock to which the option relates, which we call the underlying stock. So the value of your option is going to be dependent on the underlying price of the stock. So for example, the price of an option on Google is going to be based on the price of its underlying stock, which is Google stock. Okay, so what is an option buyer, also known as an option holder? Well, an option buyer or option holder is a person that purchases or holds an option contract and therefore has the right to buy, remember in the case of a call option, or sell in the case of a put option, the underlying stock from the option seller at the strike price. So let's just diagram this really briefly. So you've got a contract, right? And as we'll explain in a moment, some individual or entity is the seller of that contract. And as we'll explain in a minute, they're also sometimes referred to as the writer. So they have this contract, and they will give it to you if you're the buyer in exchange for cash or a premium, right? So that, in a nutshell, we're talking about the option buyer, or once you have it, you're a holder. You're holding the contract, right? So you're a holder. Okay, so let's talk about option sellers, also known as option writers. An option seller or writer is a person that sells or writes an option contract and therefore has the obligation to sell in the case of call, or buy, they have the obligation to buy in the case of a put, the underlying stock from the option buyer at the strike price. So this is just the flip side of the definition of an option buyer, right? So if you're the seller, same diagram that we basically just mapped out. You've got a contract that you are writing, or maybe you bought it from someone else and you're just now selling it. So I guess you're a writer if you are, let's say you have 100 shares, you need 100 shares of the underlying to be able to sell a contract off of it. So let's say you're selling a call option. That means you are selling someone the right to buy, therefore creating an obligation for you to sell them shares at a certain price, right? So you're drafting, if you're the seller, you're drafting this contract and providing that to the buyer in exchange for a premium, right? This is the price that the buyer has to pay. Forgive my very poor handwriting. So this is what the buyer has to pay you if you're the seller. So you collect that money, and you know, you say if the stock gets above, let's say the stock's trading at 100 right now, and you sell the $120. This is the one that you sold. So you know, on your contract, $120 the strike price, right? So if the stock never, let's just say this little chart, it's trading around 100, never quite makes it to 120. Oh, it tanks over here. If it never gets past 120, then nobody's going to exercise that option. The buyer's not going to exercise that option for right to buy your shares at 120, because it would have to be above 120 for them to be interested in doing that. And therefore, you would just pocket this premium. You would just hold on to that, and maybe the next month or the next, you know, couple months, you sell another option that expires, you know, another month or two, collect some more premium. So sellers will oftentimes just keep selling options until their shares get called away, or they can do that on puts too, right? Just keep selling puts until the stock price goes down far enough for them to be exercised. So a couple other terms that are good to have in your wheelhouse is the meaning of being long a stock or being long a position, and also being short stock or short a position. So this is not lingo that's specifically applicable to options, but it works with options just as well as with stocks. So if you're investing in stocks, you should know this as well. If you're long a position, that means you own it. You're bullish. You want that asset, whether it's stock or an option, to increase in value, right? So if it's stock and you're long stock, you want the stock price to go up. If you're long a call option, that means you own it. You're the buyer of it, holder of it, and therefore you want the value of that to increase. So you can be long. This is the somewhat confusing part. Right, so you can be long stock, which is kind of the obvious. You can be long a call option means you own it or you bought it. So in the case of a call, you want the underlying stock to go up because that will increase the value of your long call option position, right? But you can also be long a put, and so this kind of confuses people because they say, well, shouldn't I be wanting the stock to go down with a put if I'm long, or if I own a put? And that's right. So with a long put, you own it, so you bought it. You're not the seller, you're the buyer, and so you actually want the stock to go down, but that doesn't mean you're not long that position. So it's not necessarily saying the direction you want the stock to go, but it's really whether you own it, whether you're holding it or not. Now, being short, so you can be short stock. So being short the if you're short the market or a particular stock, that means you have negative exposure to the market or stock. But if you're short something, that means that you have essentially sold it. So you don't really own it. So you can be short stock. In order to short stock, what you do is you actually borrow shares from a broker, sell them. Right? So you've sold it, you sell it, and then you're hoping to buy it back at a lower price from the market, and then pay back the broker, give those shares to the broker at a lower price, and then you pocket the difference. So you sell it. You don't really. So you're not holding it. Right. So if you're short a call option, that means you're an option seller. You sold that call. You sold. Just change this to sold. Right. It's very, very bad handwriting. And so if you are short a call option, you don't want this underlying stock to go up. You actually want it to go down. So the important thing is if you are short a call, that means you've sold the call. If you're short a put option, that means you are a seller of that put option. So you sold that put option to a buyer. And so when you sell a put option, you actually want the stock to go up or stay above a certain level. Maybe I should put like little arrows. So this is what the yellow indicates what you want the underlying to do generally is. So short put, you want the stock to be going up or staying above a certain level. Short call, you want the stock to go down or staying below a certain level. Short stock, you want the stock to go down. Long stock, you want the stock to go up. Long call, you want the underlying stock to go up. Long put, you want the underlying stock to go down. Okay, so now in these next few slides, I want to talk about what we call moneyness. Okay, sounds like a weird word, but moneyness describes, kind of where the option strike price is in comparison with the underlying stock's market price. Okay, so as we explain it, it'll start to make a little bit more sense. So we have three different kind of states of moneyness that an option can have. And just to explain up front, for calls and puts, this is kind of opposite. You'll see in just a second. So the three different states of moneyness are, number one, in the money, number two, out of the money, and lastly, number three, at the money. So a stock option can be described as at any point in time, depending on where it is, the strike price is in comparison with the market price, at any point in time can be either one of those three states. it cannot be more than one at the same time. It's one of the three, as we'll explain. So with respect to a call option, just put on your call option hat for right now. And in the money options, we're talking about calls, is an option whose strike price is lower than the underlying stock's price, right? So the key words is strike price, right? So we're taking the strike price and comparing it to the underlying stock's price, okay? So let's go over here. I've got this option chain. So if you haven't ever seen an option chain, this might be your first. This is from the Robinhood app. So this is at least how it looks on an Android phone. So when you go to buy an option, a call option specifically, as you can see up here, we've selected call and we're looking to buy. So we've selected buy. You can see we've got a string of expiration dates across the top, and the one I've selected just for this example is January 15th, 2021. So it expires, well, from when I'm recording this, it's a little less than 6 months from now. And the underlying stock that I'm talking about is Uber here. Okay, so this is just for sake of this hypothetical and to show you in the money, out of the money, and at the money. So an in the money call option, let me change this color, would be all of these guys right here. And actually, I would say these guys for sure are in the money, ITM for short. Okay. At the money, as we'll describe at the very end, would be more like this guy here. Okay. And then out of the money is going to be these guys right here. Okay. So in the money means the share price is above the strike price. So if we have this 29 call here, let's say it's in the money, just think of this as kind of like a watermark, right? Where you can see the current share price is $30.04. So everything below $30 is going to be in the money. That means there's intrinsic value, okay? So if in the money options have intrinsic value, they have value intrinsically because if I have the right to buy Uber at $29 and the stock is trading at a little more than 30, then I could exercise that option contract and buy 100 shares from the seller of that option for $29, right? So I can buy 100 shares for $29, and then I would be able to immediately sell it in the market at this $30.04 and collect $1.04 per share. So right now it's got $1.04 of intrinsic value. This one does, right? And the 28 call, it's got $2.04. So I could buy it at 28 and sell it for 34 of intrinsic value. We're not to expiration yet, but the price at expiration would be $1.04 or $2.04 if this was the last minute of the expiration date. It will converge on the intrinsic value. But you can see that these options actually are selling for a lot more than that. $4.55 instead of $1.04, $5.08 instead of $2.04. That's because these are so your option value. Let me just write another diagram. Is composed of two parts. So intrinsic value, and then there's time value. So if you just if this is the overall value or the price of the option, price, just trying to abbreviate here. So if you got a chunk of the value that's going to be time value, if there's any time left before your option expires, and then you've got a chunk that's going to be intrinsic value if it's in the money, right? If it's at the money or out of the money, technically it doesn't really have any intrinsic value. If we're calling this $30 call option, maybe it has like 4 cents of intrinsic value. But so in the money means it has intrinsic value and likely time value as well, if there's time left. And think of time value as there is value to having almost 6 months left on your contract, right? Because Uber has 6 months to go higher. In the case of a call, it could go higher, and the more time it has, the more likely it is to move higher in that amount of time. So the more time you have, the more time value you'll have on these options. So like if I were to look at these March options over here and that 29 call, it would be selling for even more than $4.55 guaranteed because there's an added 2 months of time on that option contract. And so people will pay up for that additional 2 months. So it's going to be more than $4.55. Anyway, that we kind of went into more than just moneyness on this screen, but it's important to understand time value, intrinsic value, and how that kind of relates to in the money, at the money, out of the money. So out of the money, it's all just going to be, these guys are just going to be time value. There's no intrinsic value for like these 33 calls up here for $3. You're just betting on the price moving up over time, but you couldn't exercise it today and make a profit like you could with, well, not a profit, but you couldn't exercise today and have any value. $29 call or $28 call, you could. Okay, so we talked about in the money call options. Now we're going to talk about in the money put options, which is the opposite. So with respect to a put option, an in the money option is an option whose strike price is higher. So it's actually these guys up here than the underlying stock price. Let's see, I'm trying to draw. Okay, so these are the ITM in the money options up here. And that, well, let me just put the other ones up. So at the money would be roughly this 30 put because the stock's trading right around 30. And then we've got the out of the money, the OTMs down here. So it makes sense that these guys up here are in the money, which means that they've got some intrinsic value. For example, let's pick on the 32 put. Okay, so the 32 put, if you own that put option contract, you have the right to sell your shares at $32, right, at any time before expiration, or sell 100 shares. You don't have to actually own the shares, but you have the right to sell 100 shares. And so if the stock were to be trading higher than 32, that contract wouldn't really have any value to, you just sell it at the market price that's higher than 32 in that case. But if the stock is trading where it is now at $30 a share, then what you could do is exercise that put option, sell 100 shares at $32. And well, what you would really do is you'd buy the shares, the 100 shares in the market at 30. You would buy these at 30, and then you would use your contract to then sell them at $32, pocket the difference, which is this $2 difference, right? Times 100 is $200. And so you can see that this 32 put should have at least $2 in intrinsic value. But once again, why is it trading more than $2 right now? It's trading at this 520 because it's got $3.20 of time value. That's what the market's placing on this contract as far as time value, right? Which we explained, and I think that was in blue before, so I'm just gonna, here's the time value piece, right? This is the intrinsic value piece, and together, these two make up that $5.20 price. There's a component of intrinsic value, there's a component of time value. But just know for a put option, it's the opposite of a call option. The in the money ones are the ones that are higher than your strike price, as opposed to call options where it's lower than your strike price. Okay, so we already talked about out of the money on the other screen, and so I don't really feel like I need to go into it in detail here, but I'll put up, the definition here on the screen for you so that you can come back and review that whenever you want. But these out of the money ones for a call, like I said, are the ones up here. We already talked about at the money, in the money. These are the out of the money ones. Well, let me go to the next screen. And let me erase this. So now the out of the money ones are actually these guys here, right? For a put, it's the ones that are lower than the strike. So read the definition here. Won't spend too much time on that. And then at the money, in both cases, it's not really a separate definition for calls and puts. In both cases, it's just the strike that's really kind of really close to where the stock is trading. It's like at the money. So it'd be these 30 calls. So it's not really, doesn't really have any intrinsic value either, because usually it's just right at the stock price. All right, hope you learned something new if you're new to options and kind of hadn't gone through the terminology. But this may not be the most exciting course, but it will set you up for success in future courses to understand some of this terminology. So another useful piece of terminology is the bid and ask. Sometimes you'll hear people refer to the bid-ask spread, which is the difference between the bid price and the ask price. Now, the bid price is the highest price being openly offered in the market to purchase a certain asset. So in this case, we're talking about options, so it would be the highest price someone is willing to pay to buy that option contract at the moment. And the ask is the lowest price being openly offered in the market to sell a certain asset, which in this case is an option contract. So somebody will be willing to sell you that option contract at the ask. Let's just look at this example down below, sticking with Uber. So this is what the screen looks like in Robinhood when you go to purchase a single option. So you'll notice here you can enter in the quantity of contracts, because you don't have to just buy one. You could buy multiple if you wanted. But I would recommend, if you're just starting out, to start small and just buy one at a time. But you can see that the price, this is the Uber $31 call expiring in January 2021, January 15th to be exact. And you can see down here that the bid price is this $365. So remember, even though it's quoted per share for an option, because an option contract gives you the right to 100 shares, you have to multiply it by 100. So the bid here would be in dollar terms would be $365 for this contract. And then the ask, do this in yellow, the ask right here is 380. So the bid-ask spread for this option contract would be the difference between those two, which is $15, right? 15 cents multiplied by 100 is $15. So what you should do, and you can see here, Robinhood will automatically calculate for you the midpoint. So here the midpoint between the two is about 373. But you will notice that Robinhood and most brokers, for a lot of option contracts, they'll make you enter in a price that is at least to the 5-cent or 10-cent increment. So let's say in this case they'll accept a 5-cent increment, so you can do 370 or 375, right? Maybe those are your options, or 380. Well, if you did 380, you'd for sure get filled because that's what the market is asking for to buy this, if you want to buy this. So you could do either 370 or 375. If you want a more likely chance of getting filled, I would go with 375, which is closer to the asking price of 380. If you maybe want to not pay as much, you could put 370. You may get filled, you may not. Or you can just put 370, and if the stock goes down, in the case of a call, right, then the price of the option in theory should go down too. So you might just put in your order and hope that maybe there's a little bit of a downtick and you get filled at 370. So that's the bid-ask spread. You don't want to trade options that have a very wide bid and ask. Some options will have a $1 spread, let's say, or even more, which is a $100 spread. So you can see in that case, it would be, it's just not as liquid, and so you could have trouble getting out of a trade. You may get in at a certain price, and then if you wanted to get out quickly, you would have to accept a much lower price. Anyway, that's the bid-ask spread, or the definition of bid and ask.